Well, first up, Prescient Investment Management was the first investment house in Africa to be awarded a qualified institutional investor license to operate in China. The firm recently launched the China Balanced Fund, which gives investors direct exposure to equity and fixed income instruments in the mainland. Tonight, we're joined in our Cape Town studio by portfolio manager Liang Du to discuss what the portfolio has been up to. Thanks so much for your time, Liang. Let's start with what you're seeing in mainland China from an equity perspective.
Hi, Browan. I think from an equity perspective, we still very much like China. China was trading at multi-decade low valuations, and as you know, over the December month, it rallied about 30%. But in spite of that, the equities are still trading globally, Chinese equities compared to global equities, at about a 40% discount. That's pricing in almost less growth than the rest of the world, where we think China will grow a lot faster than the rest of the world over the next decade.
Liang, we've got this earnings season, I guess you can call it, that kicked off in China, and in the month of April, you said in your commentary on the fact sheet, 1,288 companies reported earnings, 579 were up and 709 were down. So in general, we talk about this Chinese economy that's still growing at 8%. It sounds like the earnings disappointed for the period over April.
I think for April it did, and I think on the background of global equity weakness, equity fell globally in April. So if you look at, it's a rolling number, so as more company reports coming out. So if you look at year on year now, you're looking at about single-digit growth. And that is a bit lower than what people would expect given the economy is growing. But having said that, China is going through a transition. So going forward, the economy is likely to be a lot slower than it is before. We're still talking about probably in the worst case scenario, about 7 to 8% growth over the next decade. But earnings should come through over the longer term.
Those, Liang, who invest in China often cite the municipal debt as a concern. I know I've asked you this question before. Can you just take us through your answer and give us an indication on whether you see it as a red flag at all?
Absolutely, Browan. I think we did extensive work on the debt situation in China. So what we did is that we looked through the entire listed Chinese companies and looked at their debt profile. It turns out that absent one sector, the Chinese companies are the least leveraged in the world. That's of course talking about the only sector that is leveraged is the banking sector. So if you look at Chinese people, they don't have any debt. The only piece that have debt is of course the banks. And the banks have loaned it not to the listed companies that we're buying. They've loaned it to, let's say, local government vehicles.
So the municipalities?
No, that's right. So it's either municipalities or countrywide, national infrastructure projects. Right. So the worrying there is, of course, that these debts go bad. Having said that, when you have about 5 to 7% growth, we're talking about actually 7 to 8% growth, but let's say even if you have 5% growth, bad debt becomes good debt very, very quickly. If you look at China as a whole, the thing that surprised me the most, we went and looked at, is China overbuilt? So one thing we're worried about is China pulling a Japan in the 80s, where you're massively overbuilding fixed income assets? And what we found out, amazingly, was that actually it's not. If you look at the rail network, if you look at the road network, if you look at it on a per capita basis, it's actually underbuilt. So we think that in the short term, these projects are going to be unprofitable, but with 5 to 7% growth on the longer term, it's going to fix itself quite quickly. Now, even in the event that it doesn't fix itself and these things actually go bad, if you look at the Chinese government position, it's one of the strongest governments in the world in terms of their balance sheet to be able to handle a crisis of local government proportions. Finally,
I don't want to
for it in the equity market.
I don't want to sidetrack the conversation completely. Warren, you need to jump in here.
Liang, that's right. So obviously we don't know too much about the Chinese fixed income space, and the municipal debt, I presume you'd have access to through public markets, but we're very familiar with the sort of three-factor approach that you take to equities. I wanted to ask you specifically around the fixed income side, how have you gone about selecting what you've brought into that portfolio, and what sort of yields are you enjoying in the fixed income space in China at the moment?
Okay, so in the fixed income side, right, the Chinese fixed income market actually has a lot of opportunities. The first thing you'll see is that straight up government debt is yielding about 3.5 to 4.5%. Now, as you well know, the currency is tied to the US dollar, so immediately that gives you almost 3% free money. Of course, assuming that the RMB will not weaken, and in fact, it's been strengthening over the past period. If you take a step up above that, what you can see is you've got the national development banks, of the government, and you get picking up about 100 basis points on top of government debt. And on top of that, you get almost hundreds of corporates that's listed in the interbank market. Now, you'll be surprised to know that on the interbank market, all those municipal debt, the borrowing that they've issued to the municipals, they do not feature on that bond market. Even on the interbank bond market, they don't want investors accessing that. The ones that are listed are very, very high quality corporates, and they even trade between a 200 to 400 basis point yield pickup compared to government debt. So that market looks quite attractive. At the moment, we have very, very little invested in Chinese fixed income. That's simply because we have a limited quota in the fund. So the government gives us a quota, we've completely filled up our quota, and to us, the best opportunity right now is equities, and we're in equities.
Your exposure is some 87% to equities in the exposure, if I'm correct, or in the fund, if I'm correct. Let's talk about your sectoral bias when it comes to Chinese companies. Is there a heavy consumer bias?
Okay, when we looked at the Chinese market, what is very interesting that picking sectors in China is extremely difficult. So what I mean by that is that if you look at the sectors that are supported by government policy, suppose going forward, what you're looking at the IT sector, the healthcare sector, and the renewable energy sector. All three sectors, the IT trades at a P of 60, the healthcare sector trades at a P of 33, and the renewable sector also traded at a P of mid-30s. What we found in China is that most of our models are actually sector neutral, and we buy quality, cheap companies within the sectors, and we can generate alpha that way.
So you're going for a value bias there, Liang?
We have a value bias, we have a quality bias, and our third factor is, of course, behavioral finance. It's sentiment driven. There's a massive retail market in China that plays in the stock market, and we try to take advantage of that.
Liang, you've indicated that the resources sector's had a bit of a tough time over the last little while. What's the sort of perspective around the sentiment and obviously the valuations of resource companies in China?
So if you look at Chinese resources companies, their earnings look a lot better than the South African ones. Globally, resources companies has taken a dive. So Chinese resource companies are also down. But of course, what they don't have is, of course, the labor unrest that we see here in South Africa. So they have that step up. We look through the portfolio, actually, the one resource company we do hold is actually a rare earth metal company, which has an ROE of about 25% and PE about 12. So we find that to be quite a good opportunity.
Liang, in terms of the performance of the fund going forward, where to for Chinese equities from here? And I go back to the fact that 87% of your exposure right now in the Prescient China Balanced Fund swings into the equity category.
Oh, absolutely. I think the China Balanced Fund, as itself, by being so much invested in equities, looks rather risky. But I think as a building block of a portfolio of someone who has a global portfolio, someone who holds equities in the US, in South Africa, it makes a perfect building block to mix it together. I think we're looking at multi-decade low valuations in China. And to me, I think when we invested into China, the question was, if I'm not max equity now, what do I need to see to be max equities? And after considering that question for a long time, we decided, it's a good opportunity. We should be max equities. It's not something that you just have 100% of your money in. It's part of a bigger portfolio, and altogether that works very well.
Liang, we've obviously quite interested. You're coming through the listed companies with your quantitative model, and I wanted to get a perspective on what the sort of makeup was between large cap, mid cap, and small cap shares in your universe. Is there a distinct bias to finding value, particularly in the small and mid cap space in China?
Warren, much to your surprise, you'll find that in China, things actually go the other way around. Actually, perhaps not so much of a surprise given the large retail sector bias, but small caps and mid caps are massively overvalued. Small caps often trade at P's of 50 or 60, and mid caps trade at P's of 30 to 40, and that's because people are looking for growth and people are punting for growth. So I think the lovely thing about in the Chinese portfolio is that although we have a slight tilt toward mid cap and small cap, mostly we invest in very high quality large companies trading at very, very reasonable valuations. And I think that's a good opportunity. You
talk about the large caps, Liang. We're very interested. Obviously, we're very unfamiliar with the Chinese market. I think, we're still going to get used to this idea of the CSI 300 index, which is, I guess, going to be the equivalent of the S&P 500 going forward. But tell us a little bit about some of the big Chinese companies, names that if we're not familiar with now, we're going to be very familiar with in the next 5 years.
Okay, perhaps I can tell you about some of the stocks in our portfolio that's in the CSI 300. One of the companies we bought, geez, I'm going to speak about Chinese company name live on TV. It's called Fuyao Glass, okay? And what they do is that they make glass for global car manufacturers. You talk about Volkswagen, Daimler Chrysler, Audi, BMW, or the Chinese brand, etc., etc., etc. So once again, very reasonable valuations, PE of 10, REs of 20. Another company that we've bought, it was Zhengzhou Futong Bus. And
I want Warren to
Chinese people love their
repeat. I
bus.
want Warren to repeat that on the desk. You can do it.
I refuse. No, I'll give that a skip.
Liang, we need some Chinese lessons
You'll give
in
that a
studio. Sorry, I interrupted your train of thought.
Absolutely, it's the future of the world. But you're right, it's a bus company. Chinese people, of course, given there's so many people coming out of the villages into the cities. They sell buses and they sell energy efficient buses, and it's a lovely story. It's a lovely company, high quality, good earnings prospects once again. It goes without saying they have a huge financial sector. You've all heard of ICBC, you've all heard about their construction banks, China Construction Bank, etc., etc.
Leon, we've got this perception there's a big problem with pollution in China, and we wanted to just get perspective in that particularly. We understand that many large cities are struggling to contain noxious gases and emissions from manufacturing plants, etc., etc. Is that really the green sector in China? Is that the golden blue sky for the next 10 years?
Absolutely. If you look at government policy, they've done the efficient things. So firstly, is they closed down a lot of these inefficient small factories and converted them into the bigger factories. So small, inefficient, polluting factory were forced to close down. It's lovely being China that you can do things like that. The second thing is, of course, the renewable sector. China already is one of the countries spending the most money on R&D and renewables. And that'll be very exciting going forward. I think China as a country realizes that it's impossible for them to grow the way other countries has grown, given that they have so many people in such a small area, and renewable energy is going to be a big thing. So there's a massive amount of research in renewable energy in China.
Liang, I just want to
I wouldn't be surprised at the next...
Sorry, finish that train of thought and then I'll put my next question to you.
No problem. I said I wouldn't be surprised if the next renewable giant actually comes from China.
I want to go back to the macro picture and look at the global story. If we see a continued slowdown out of Europe, for instance, numbers get worse and worse, and the US perhaps now falters, and we don't see this steady recovery coming to the fore. Has China got enough of an internal engine when it comes to growth to sustain itself and to sustain the current growth rates and remain somewhat insulated from the global picture? Or with the global picture under pressure, will that weigh in on China?
Browan, I think absolutely. I think right this second, China do not have a strong enough growth engine if US and Europe absolutely collapses. So if they just have a mild recovery, I think China will easily get through this path. But if both of them collapse, then China do not have a strong enough growth yet. But I think there's exactly this realization that made the Chinese government, the new government that came into power, have a completely new policy. I think the previous few times I've been here and I chatted about it, they didn't have a name for it. But now they're calling it the Chinese dream. So it's a phrase coined by Xi Jinping. And I think intentionally they want to bring it back to the American dream, where now the Chinese dream is about growing the China people, making them consume more, allowing them to go up the value chain. And that'll create its own growth going forward over the long term. But in the very, very short term, China will still be reliant on the export engine that it has built itself.
Liang, just a final question around the fund itself. Obviously, you're one of the first, you're the first investment house in Africa to get exposure as an institutional investor in China. The fund launched fairly recently. You've already filled up the quota. How do investors get into this now? Because this quota system that the Chinese government imposed sounds pretty bureaucratic. Just talk us through that.
Okay. I think given that we've filled up the quota, what investors have to do now is they can put their name down on a list. So we have a list. If you put your name down and your interest, if anyone disinvests, we will put you back in. The second thing is that the Chinese government is loosening up. So you've seen that they've increased their quota limits by a huge margin over the last 2 or 3 years, and we expect them to continue to do so. The only restriction they have is we can only apply quotas for once a year. So our quota, the deadline comes up in September, and in September we'll immediately apply, and hopefully in the near future after that, we'll get new quota, and that will allow us to put investors into the fund.